So far this year, we've seen rapidly changing narratives across credit markets. Earlier in the year, software companies came under pressure as investors grappled with the potential disruption from artificial intelligence. At the same time, we've witnessed an enormous wave of debt issuance, albeit predominantly in the investment grade market, from the hyperscalers and data center companies helping to finance the AI boom. Private credit has also been in the spotlight with questions around liquidity, valuations, and parts of the software sector proving particularly topical, albeit a systemic overlap impacting high yield appears quite limited. Meanwhile, markets recovered quickly from geopolitical shocks that, at the time, appeared capable of causing more lasting disruption. And as always in high yield, there have been a number of idiosyncratic company stories that have created both risks and opportunities for active investors. Against that backdrop, I think it's worth stepping back and asking a broader question: what does today's high yield market actually offer investors? Currently, the high yield market presents investors with something of a paradox. Investors can earn in excess of 7% yield by investing in the global high yield market. Historically, starting yield has been an excellent predictor of long-term returns. So from that perspective, today's market remains attractive. But at the same time, credit spreads are relatively tight by historical standards. That has led some investors to question whether they're really being paid for taking credit risk. It's a reasonable debate. Personally, I'm still a strong believer in high yield. Not because I expect significant capital appreciation, but because I think investors sometimes lose sight of what the asset class is designed to do. High yield has always been an asset class built on compounding income over time. If you only invested when spreads looked unusually high, history suggests you would own the asset class relatively infrequently. You might capture some attractive entry points, but you'd also miss long periods where patiently collecting income has been the primary driver of excellent long-term returns. The other point that's sometimes overlooked is that today's high yield market isn't the same market that earned the nickname junk bonds decades ago. The average credit quality of the market has improved significantly over time. So for me, the question isn't really whether high yield deserves a place in portfolios. It's how to navigate the opportunity set.
One of the biggest themes across credit markets today is financing the enormous investment taking place around artificial intelligence. For now, much of that issuance sits in the investment grade markets, but it reminds me of previous periods when a single investment theme came to dominate parts of the credit market. Many investors will remember the TMT boom around the turn of the century. More recently, we've often used the energy sector over the past decade as an example. As sectors grow, they naturally become larger parts of the credit indices. If you're managing against an index, you're increasingly encouraged to own those sectors, irrespective of whether your conviction comes from the underlying credit or from the broader theme itself. Perhaps in the years ahead, that conversation will increasingly center on data centers and AI infrastructure. We don't think an index should dictate where risk is taken. Instead, we'd rather ask whether an individual issuer offers an attractive idiosyncratic credit opportunity. And if our conviction is really about the broader investment theme, whether that's oil prices, artificial intelligence, or something else, equities are often more of an effective way of expressing that view, because the upside from getting the thematic call right isn't capped in the same way it is in fixed income. Another topic that's attracted considerable attention this year has been private credit. Private credit will have attractive characteristics, and there are times when investors are well rewarded for accepting lower liquidity. But liquidity premia aren't constant. Sometimes they provide attractive additional returns. At other times, they can become a source of risk in themselves. Our approach has always been firmly rooted in the public high-yield market. We invest in liquid, publicly traded bonds. For example, we do not own any unrated bonds. Our use of derivatives is deliberately straightforward and is largely confined to currency hedging. Our PRISM research framework naturally guides us away from the weakest part of the credit spectrum. That doesn't mean we're trying to build a defensive portfolio. Our long-term performance demonstrates that investors haven't needed us to take every risk available in the market in order to generate attractive returns. Instead, we try to be highly selective about the risks we choose to own.
A recent investment in bonds issued by a company called Pagaya illustrates well our process and philosophy of looking for idiosyncrasy ahead of thematic risk. This was a business growing really well, operating well, but the bond price trading at a stressed price. Pagaya is a fintech business involved in lending decisions, but also retains some credit risk on its balance sheet. With the headline risks emerging from the private credit space, it was easy to spot what investors here were fearful of. It has technology helping lenders identify borrowers who would otherwise have been declined using conventional underwriting models. Rather than primarily lending significant amounts of its own balance sheet, it earns fees by helping financial institutions originate loans and connecting those loans with institutional investors. The business remains exposed to consumer credit and securitization markets, but after completing our research, we concluded that the market had become overly focused on those headline risks and wasn't giving sufficient credit to the underlying quality of the business, its funding relationships, and its long-term earning power. The opportunity wasn't simply that it offered a high yield. The opportunity was that we believed the market had mispriced the credit risk based on sentiment. Meanwhile, US consumer credit risk is not a strong theme in the fund. Indeed, we trimmed our existing singular direct exposure to US consumer credit to make room for Pagaya. We believe the best way to harvest the long-term compounding income in the asset class is to control thematic risk, seek idiosyncratic risk, ignore your benchmark, and avoid concentrations of default risk. With so many competing narratives and risks in financial markets, we view 7% yield as an attractive medium to long-term opportunity for an active approach to this asset class.